Strauss with the Federal Reserve Bank of Chicago, Senior Economist and Economic Advisor.
Hi, I'm Paul Piper from University of Illinois at Chicago.
Anna Oppenheimer, I'm a Senior Risk Specialist here.
And I'm Vivian. I'll be the timer today. Your team will have 15 minutes for the presentation, followed immediately by 15 minutes for judges' questions and your answers. I will give a 2-minute warning holding up a sign and a 1-minute warning holding up the respective signs. When time is up, I will say time. If a judge is speaking when I call time, then the question will not be included, nor the answer. And if a team member is speaking when I call time, then they may finish their sentence or thought, but then stopping after that. No other members may speak after that. Do you have any questions? All right, start.
Welcome to the November 2018 FOMC meeting.
My name is Travis McBride.
Lance Jordan.
Bernadette Becker. So we are starting by covering our dual mandate. We want full employment and price stability through gradual adjustments to the economy. And in order to increase our economic expansion and keep our labor market strong, we expect inflation to hit the 2% target for this 12-month period, the symmetric objective. We're starting today with the status and trends in our economy, looking at inflation first, unemployment measures, then financial markets and other measures, leading into policy updates and recommendations.
As Jerome Powell has made very clear over the past several months, the Fed's target is 2% symmetric inflation. This means anywhere from 0 to 4%, targeting approximately the center whenever possible. Currently, the PCE, the main measurement for the Fed, measures inflation as being at 2.2%, and core PCE measures it at 1.9%, and we expect this to be a more consistent trend into the future.
Let's take a look at inflation. When we consider inflation, we look at core CPI and core CPI. It tends to overstate inflation by 50 to 100 basis points. The quarterly CPI grew 2.6% year over year, and core CPI grew 2.2% year over year.
Now let's look at the productive side of the economy. It should be monitored given, the PPI should be monitored given the current trade climate and because it's a leading indicator for CPI. Currently, the PPI for final demand has increased 2.7% and final goods has increased 2.9%. Final demand services has also increased 2.4% all year over year.
Real GDP and potential real GDP allow us to see whether we are in an inflationary or deflationary gap. Since the second quarter of 2016, we've seen a steady increase in GDP, and in the third quarter of 2018, real GDP has increased 2.9%.
Now, back when real GDP and potential GDP were chain-weighted to the same 2009 dollar, the inflationary gap began in the second quarter of 2017. However, since we cannot accurately date the inflationary gap given current data, we have to wait to make recommendations based on this until it's chain-weighted into the same 2012 dollar.
Let's take a look at unemployment. Headline unemployment in September was at 3.7%. Natural rate of unemployment was at 4.62%. So this indicates that the labor market is tightening. Also, the usage rate in August has increased 10 basis points to 7.5%.
Continuing with the labor market, labor force participation rate has been at 62.7% in September, has been steadily declining since the Great Recession, and has remained stable near 63% since 2016. It may point to leveling off of the labor force participation rate as well.
Now, a February 2018 Congressional Budget Office report examined the labor force participation rate for the age group of 25 to 54, and it found that men primarily left due to illness and disability, which is supported by Kruger 2016, while women, on the other hand, left primarily to take care of family members. Now, within the same age group of 25 to 54 years of age, we've seen an increase of disability insurance. Back in 1990, it was only 1.5%, and as of 2017, it's 2.7% now.
Looking at income and wages, with the U3 below the natural rate of unemployment by 80 basis points, as in the second quarter of 2018, we would expect that wages should be increasing more than the 50 basis points we've seen them increase, but we think that wages are constrained based on the compensation structural change we've seen. We've seen variable pay increase by 7.1% as opposed to base pay increase the last 25 years, according to Ken Bosch of Hewitt.
Now, keeping with wage growth, I'd like to take a second to look at the Atlanta Fed, or what the Atlanta Fed publishes, which is a measure of nominal wage growth of individuals based on microdata given to them from the Current Population Survey, or the CPS. It found that in September, the 25th percentile of earners saw a decrease in wages of 1.9%. The 50th percentile saw an increase in 3.5%, and the 75th percentile saw an increase in 13.3%, making the average increase 4.9%. Now, this should point to an inflationary pressure. However, we also do not have within this data the wages from those who are self-employed, such as business owners and contractors. Additionally, it should be pointed out that we have major companies such as Walmart, Amazon, and Target who have increased their base pay across the board.
Moving on to the trade deficit. The trade deficit has increased 20.5% year over year. According to data from the BEA and the U.S. Census Bureau, the trade deficit in September is up 6.4%. In August, exports of goods for September were down 80 basis points from August. Imports of goods for September are up 60 basis points from August. This is a decrease in U.S. exports drives down the economy and lessens the inflationary gap. If exports continue to decline, this could ease up the tight labor market and put downward pressure on wages.
Let's take a look at tariffs. Essentially, tariffs decrease imports and increase exports. This is likely to happen because of the higher production costs in the U.S. We are experiencing retaliatory tariffs from China and the EU, Mexico, and Canada.
So looking then from the international trade to the currency markets, the U.S. dollar index comparing the U.S. dollar's valuation to 6 major world currencies show the dollar is decreasing since December 2016, with a brief uptick since February of 2018. We're weak in comparison to these other currencies, but we do expect that tariffs will increase the exchange rate for the U.S. dollar, increasing the valuation, which will be counterproductive to the desire to get more U.S. exports.
Now, I'd like to take a minute to look at the housing, specifically using the Case-Shiller National Housing Price Index. And we can see that there was this increase of 6% year over year. This increase started back all the way in August of 2016.
Also, with housing, new housing starts has increased by 1.6%. This is a sign of a seasonality in the market. Also, due to the high housing market, we expect that housing starts to increase in the short to medium run.
Continuing with housing, the homeownership rate has increased by 90 basis points year over year. There's been an upward trend since Q2 of 2015. At the same time, the S&P Case-Shiller Home Price Index has increased 6% year over year. The rental vacancy rate is down 6.8% year over year, and that should be noted that the S&P Case-Shiller Home Price Index has been declining since April 2018.
Now turning to the business side of the economy, advanced retail sales, not including food, has increased 4.4%, but it's down from May when it was increased to 6.3%. Consumer sentiment has decreased by 60 basis points, but we expect an uptick with the holidays around the corner. Business inventory is approximately at 4% as of February 2018 and stabilized. Business establishments is finally at pre-recession levels, but it's a lagging indicator, and we need to see how tariffs will impact it.
I'd like to take a moment to look at the stock market, specifically within the S&P 500. Now, we've seen an upward trend since the Great Recession, and this is a good indication that investors are showing more confidence within the markets. However, during the course of October, we've seen not only the S&P 500, but also the Dow Jones and the NASDAQ decrease more than once. Now, this could be due to a few reasons. Firstly, you have shrinking profit margins, or shrinking corporate profit margins, an increased cost in borrowing, tariffs, instability in the European Union caused by Italy's indebted banks, and also an increase in oil prices, which could put downward pressure on stocks.
Also with the S&P 500, we've seen like stronger stocks can lead to consumer sentiment and consumer confidence increase. This should increase GDP, should spur more job growth. We believe that overvaluation of the market can lead to a possible correction. So also this could have negative wealth effect on consumer sentiment.
Moving on to the yield curve. Now, a flattening yield curve is generally associated with stagnant growth, but that doesn't exactly paint the picture that we see in the current U.S. economy. With nominal interest rates being equal to expected inflation, plus real interest rates, plus your risk premium, this leaves us very few options as to why we're seeing a flattening yield curve. Firstly, it could point to expectations of inflation are low, which is very understandable as we've been in a low inflation environment for some time now. Additionally, it could point to real interest rates are being held low as well, which again, understandable as we have seen that for some time. net shrinking of the term spread could affect investor sentiment, and a term approaching zero signals to the overall economy that it could be weakening and warn of an impending recession. If the yield curve inverts, there will be a downturn in the economy as shown by Kessler studies.
Moving on to the Fed's balance sheet. Currently, the Fed's assets are around $4.2 trillion. There's been a gradual unwinding of the balance sheet, which began in September 2014 by ceasing reinvestment of principals on securities held in the system open market account portfolio. And most recently, the Fed has increased the amount of roll-up of securities from $50 billion a month, from $40 billion a month to $50 billion a month, which could allow the Fed more options if the economy were to take a downturn.
So let's look at the review. What are our positive trends happening in our economy?
We are below the natural rate of unemployment. Headline unemployment. Wages are slightly increasing, but not enough to cause cost-push inflation.
Now, our real GDP is also has grown by 2.9%, and we're hitting our symmetric 2% inflation target, which is 0 to 4% inflation.
Now, housing starts and new businesses are on an upward trend while mortgage rates are increasing. This could slow down the housing market, and it has been on the rise according to the S&P Case-Shiller Home Price Index since 2012.
So what are the negative impacts hitting our economy?
So the U6 unemployment rate is currently double the U3 unemployment rate, which may be why we're not seeing an increase in wages at this time.
Also, the bottom 25% have seen their wages decrease by 1.9%.
We also need to take into consideration the stock market, as if that continues to decline, this could negatively affect investors and really hurt consumer sentiment, which we are worried about a negative wealth effect occurring if it continues.
We also have slowing inflationary pressures from current trade policies and tariffs, as well as the expansionary fiscal policy through tax cuts. And with a flattening yield curve, if it inverts, we will most likely see a downturn in the economy.
So with those in mind, what are our recommendations?
I think keeping the federal funds rate between 2 and 2.25% would be appropriate for now. However, we really should consider it if inflationary pressures continue by the next meeting.
Also, we should decrease the interest on excess reserves to encourage more activity in the federal funds market.
And lastly, given the inflation and inflationary gap are a concern, if there is inflationary pressures, we should consider draining reserves from the system by implementing term reverse repos as needed.
All in favor of these recommendations, say aye.
Aye. Unanimous. All right. Thank you. So Jerome Powell took office as chairman of the Federal Reserve System on February 5th of this year. And on October 11th, just a few weeks ago, President Trump said regarding the rising interest rate environment, quote, "The Fed is out of control. I think what they are doing is wrong," end quote. And then when Trump was later asked about the future of Fed Chair Jerome Powell, Trump said, quote, "I'm not going to fire him," end quote. I'd like you to comment on these statements.
Now, the president and the chairman of the Fed have had a long history of not quite seeing eye to eye. It is the Federal Reserve's responsibility to have their dual mandate, which is maximum employment and price stability. And with those, you should see sustainable long-term growth, which is why we have the symmetric 2% inflation target. While President Trump can make comments as to the Fed is out of line or anything of that nature, it is their responsibility to keep in mind their dual mandate, and that is their first priority, not the priority of the fiscal policy.
And the Federal Reserve is not beholden to the whims of the president. Their dual mandate was set in place by Congress. So their job is not to do what the president wants them to, it is to do what's best for the economy, whether the president likes it or not.
And as I kind of mentioned before, we're seeing a conflict in Trump is trying to do expansionary monetary policy, but we are trying to normalize the budget and the balance sheet from the extraordinary measures we had to take post the recession. So there is kind of this conflict as we are employing contractionary monetary policy and he's trying to do expansionary monetary policy, so it's understandable he's frustrated because we are at odds.
And I think that it can be, in my opinion, it's fairly clear that the president does not have the same understanding of economics as the Federal Reserve does, both through his trade policies, the expansionary fiscal policy during an inflationary gap, and other measures that he's taken, compared to the policy or understanding of economics that the Federal Reserve has held for many, many years.
But by the last point that he made there, what would be the impact if in fact he fired Chairman Powell?
The impact if he fired Chairman Powell. Already, I would say that he has broken from traditional policy for presidents who have kept Federal Reserve chairs in for multiple terms across party lines. You saw it with Greenspan was there for a very long time. And within that, trying to put in place somebody else, I believe that the Federal Reserve has been fairly consistent on their policies and is fairly agreed on how to implement policies. So finding somebody else to put in place that would agree more with Trump as opposed to with Powell or with Yellen would be very difficult.
And I also think that in the short run, we will see some potential volatility in markets because of uncertainty from that impact from firing Powell.
Additionally, going back to Chairman Volcker, the Fed has made it very, very clear that they are wanting the symmetric 2% inflation target. Now, the lengths to which they go to enact this is up for debate. However, it is their primary goal of inflation first.
Let's talk about that 2% inflation target. Why do we have a 2% inflation target versus some other number? What's special about 2%?
The key thing we need to focus on here is that it's a symmetric 2%, which has been stressed many times by Chairman Powell. Now, the symmetric 2% allows us to have a larger window of 0 to 4, so there's more discrepancy when you enact contractionary monetary policy and expansionary policies.
Another thing to focus on is the fact that we cannot have growth without inflation. Some measure of inflation is necessary for economic growth, and it's a trade-off. We believe that based on historical trends, this is a healthy level of growth that is sustainable. And that's one of the reasons that we choose this measure.
And that symmetric 2% from 0 to 4 allows the Fed to enact policy in their own time without causing additional volatility to the markets.
And given that we are a mature economy as well, it's kind of good to go with the growth rate as well as the GDP, which is around 0 to 4% as well.
Thank you.
So the Board of Governors received input from many sources. I was wondering if you could comment on if you knew who the Federal Advisory Council was and what their role is.
Could you repeat? I could not hear you.
Sure.
Sorry.
Do you know who the Federal Advisory Council is and what their role is?
Are you referring to the FOMC?
No, but it's okay, we can move on to questions, that's all right.
Okay. So in the discussion about trade, you talked about the trade deficit increasing. Most recently with exports, so this year we've seen those decline and imports rise. Kind of the opposite of what you would think the tariff story would do, right? Where we heard import. And yet the dollar strengthened. Why would the dollar strengthen if the trade deficit increasing? Isn't that counterintuitive?
Yes, it is somewhat counterintuitive. The trade deficit brings in a lot of complex issues as it's affected by many, many different things. So, because of the tariffs, we are seeing a lot of playback between countries. So we've implemented tariffs on China, Canada, the EU, Mexico, counter to many of our historical long-standing trade treaties. And because of this, we have seen retaliatory tariffs. And this has meant that our exports have significantly declined, which has caused adjustment within our market. Because people are less willing to invest in the U.S., we're seeing issues with the flow back and forth in the financial markets.
Also, one key element to understand is that whenever volatility increases in the global market, because we have a globalized economy, reserve currencies are sought after. And the United States, despite our faults, is still considered to have a strong reserve currency. And that's one reason that we see the dollar increase, which is another counterproductive measure that President Trump doesn't understand, is that when he increases volatility in the market, the dollar evaluates rather than depreciates, meaning that our possibility of getting even more exports from the U.S. economy is unlikely.
Thank you. Paul?
this one. No, we do not, but that is given current data that we can obtain from the Federal Reserve sites. Now, real GDP is chained to a 2012 dollar, which is higher than the 2009 chain-weighted dollar, which is what potential GDP is still chain-weighted at. This skews the data in favor of the inflationary gap beginning soon.
So your chart was screwed up, is what you're saying?
Yes.
Because that's how the current data
Yes.
is reported.
Okay, to follow up on that, you know, conceptually, how would we measure potential GDP? And how do we know whether we're above or below?
So potential GDP is calculated by taking, in parentheses, 1 minus the natural rate of unemployment divided by 1 minus the actual rate of actual GDP, and then you multiply that by the actual GDP, and then from there.
And how do we know what the natural rate of unemployment is?
The natural rate of unemployment is calculated by the rate of job finding divided by the rate of job finding plus the rate of job separation. And right now, I believe it's sitting at 4.62%.
Okay, so the actual rate of job finding and the actual rate of job separation is how you would do that.
So I think it was with regard to, what was your name? I'm sorry, sorry.
So you kind of have a unique recommendation. I was wondering if you could go into why you chose those specific tools and what other tools you might have considered.
The federal funds rate has been a very long-standing tool for the Federal Reserve. Currently, we're recommending to hold it where it is for a variety of reasons, one of which being concerns over an inverted yield curve.
Additionally, we believe that decreasing excess reserves, or the excess reserve rate, is technically expansionary monetary policy. It would help to increase activity within the federal funds market.
And the goal also is to make sure that the federal funds rate remains effective. With too much in the way of the excess reserves, we see the federal funds rate being less effective. We've already seen a trend of the Fed moving away from this by the fact that we have decreased the peg from the top portion of the federal funds rate to a middle portion. And going on to the understanding of the reverse repos, this is the idea of we have an excess of liquidity in the market. We want to seek normalization, as we said, from post-recession. And this would be one of the tools to be used very carefully and gradually to remove liquidity in the market.
Now, the liquidity Bernadette is hitting on is actually caused through excess reserves as well. If you look at historical trends, excess reserves wasn't really a thing, it was held constant. And back in 2008, when excess reserves were implemented, we've seen this huge increase as they created a secondary market for banks to be able to get more money.
Another option we could have recommended as well is actually sell or buy treasury bonds to decrease or increase the Fed's balance sheet, which would have an expansionary or contractionary monetary policy as well in the economy.
Which is another long-standing policy of the Federal Reserve for affecting the markets.
Okay. So I'm going to follow up a little bit with the comment that was made with regard to the inverting of the yield curve.
Yes.
Earlier this month in Boston, Chairman Powell discussed the inverting of the yield curve, and he didn't seem too concerned about it at that talk at the National Association of Business Economics. Why should we be concerned about inverting of the yield curve? And why does the economy go into recession a lot of times in the aftermath of an inversion?
So the Federal Reserve, whenever they speak, they are very, very, very careful about what they say. Because some might argue that the market places too much weight onto what the Fed says or mentions as far as for economic forecasts, which means that if they say something remotely near any statement saying that the economy might have a slight downturn, the markets will react as if there is going to be a downturn. And so they have to be able to say that the economy is doing well for as long as they possibly can.
Kessler was the first person to notice the relation between the inversion of the yield curve and a downturn. Now, if the yield curve were to invert, it's a 60% chance roughly that there would be a recession. However, that's 3 periods.
But that's all probabilistic. I want the economic explanation underlying the inversion.
Understanding what that means is that for long-term investments such as the 10-year bond rate, we see that there's actually a lower expectation and a lower return, which is fundamentally unnatural in the economy because whenever we have a long-term yield, it should include a risk premium and it should include a long-term growth rate. So if we see that the short-term benefit is higher than long-term benefit for investment, that's fundamentally a lack of confidence in the market, and people will seek short-term gain rather than long-term investment, which is an issue for the growth of our economy.
And it decreases banks' willingness to lend money, as many times they will borrow money at short-term interest rates in order to lend at long-term interest rates. And if short-term interest rates are higher than long-term interest rates, they have no interest in doing it.
Thank you.
Let me just ask you a question about the structure of the FOMC. The latest FOMC meeting, how many members actually met?
I believe there were 9 members. You had Powell, Williams, who's the vice president, Thomas Barkin, who was from the Fed, Raphael Bostic from the Fed, Labiel, I don't know how to pronounce the last name, I apologize, from the Board of Governors, Richard, I don't know how to pronounce the last name again, I apologize, from the Board of Governors, and a few others.
When you say the Fed, what did you mean by when you say from the Fed?
Like heads of the 12 central banks,
Okay.
they come from there.
And how many times does the FOMC meet a year?
I believe they meet approximately 4 times throughout the year.
Actually, they meet 8 times regularly.
And do they take a formal vote at the meetings?
Yes, I believe they do.
Yes.
And have there been any sort of dissents this year at the FOMC meetings regarding the directive?
I believe there have been dissents because Raphael Bostic actually of Atlanta wanted to increase and follow the schedule of rate increases. And when seeing some pushback, there was some discussion about that.
Your time or
Yeah, 30 seconds.
30 seconds? You got a quick one in?
Quick